Hi guys, welcome to the fifth lesson of Trading Basics Part 2, Dividends. Last lecture, we discussed the exciting ETFs. Here, we'll tell you more about dividend and their advantages. First thing first, let's talk about the definition of dividend. A dividend is a contribution of a portion of a company's earnings paid to a class of shareholders. Dividends can be issued as cash payments, as shares of stocks, or other properties. When a corporation earns a profit or surplus, the corporation is able to reinvest that profit in the business and pay a portion of the profit as dividend to shareholders. It is particularly good if you have a good chunk of money and you want to leave it in the hands of strong companies and enjoy the profits they make over time. How does dividend work? Basically, dividend payment is calculated based on a constant amount per share, not the percentage of the stock price. For instance, if a company currently has $50 per share and they decide to pay the contributor $1.5 each share as dividend, and if you buy 100 shares, you will get 100 times 1.5 equals $150 as dividend from the company. Now, if over the course of the year the stock price raises to $100 per share, you will still get $1.5 each share as dividend, and this leaves you the same amount of dividend per year, unless the company decides to raise the dividend per share given its growth. Usually, this announcement will be made in public at a certain time. As you can see, your dividend payout is not the percentage of stock price, or it's variable throughout the year. The dividend is shown as percentage in websites and brokerage sometimes, but this should not trick you into thinking that the raise in stock price will immediately lead to raise in dividend payout. There are a few dates that are very important when it comes to the study of dividend. These dates are declaration date, in-dividend date, book closure date, record date, but the most two important dates are ex-dividend date and payment date. Ex-dividend date is the day on which shares bought and sold no longer come attached with the right to be paid the most recently declared dividend. In the US, it's typically 2 trading days before the record date, which is the official date dividends are to be paid. Payment date is the actual day on which the payments are deposited to shareholders' bank account or checks are mailed to their addresses. As you can see, the ex-dividend date is very important in the sense that if you want to be paid dividend for a particular quarter, you better buy it before ex-dividend date so that the number of shares you bought is calculated in your dividend payout. By the way, your broker should be able to provide you with all of these dates, especially payment date and ex-dividend date. Otherwise, you can utilize company websites, Yahoo Finance, Google to find out these important information. Now let's talk about DRIP. DRIP stands for Dividend Reinvestment Plan. Basically, you inform your broker that whatever earning you will make from dividends should be reinvested in buying more stocks, and as a consequence, earning more dividends. This is a great example of compounding interest method, where your money makes you more money. The only thing you need to remember is to buy enough shares in the first place so that its collective dividend is big enough to buy at least one share of the company you are trading. By the way, this is how rich people get richer every day. How often do you get paid? Depends on the country you live in. For example, it is quarterly in the US, semi-annually in Japan, and in Australia and Germany it is annually. Although we mentioned that dividend payment is not calculated based on the percentage of a stock price, there is important relationship between dividend and stock price. After stock goes ex-dividend, that is, there is no anticipation of another extra dividend payment for that period, the stock price should drop. Since the company has paid, say, X dollars amount in dividends per share out of its cash account, the equity account, that is the stock account on the right side, should decrease by an equivalent amount. This means that an X dollar dividend should result in an X dollar drop in the share price. This is another reason to remember the ex-dividend date and take its price drop into considerations so that there is no surprises. Does a higher dividend means better? Not at all. If you think you should always go for companies with higher dividend payouts, you are sadly mistaken. Usually, strong, reputable companies have dividend payouts in the tune of 3 to 4% a year. If you stumble upon a company that's offering 8% dividend, you should be very careful with that company, as it means it is a trick by that company to entice general public to buy its declining share price so that it doesn't fall further. There are, of course, exceptions, but 8% dividend seems too good to be true. Coming up next, we'll discuss taxation on stock market gains. Congratulations for completing this lesson on dividends. If you want to find out more, visit our website at www.marketnewbie.com, subscribe to our channel, follow us on Facebook and Instagram page. Again, feel free to leave any comments or questions and we'll get back to you as soon as we can. See you in lesson number 6.